Long-term liabilities are by definition amounts due to creditors after 1 year. Types of long-term liabilities include notes payable to banks, bonds payable, things of that nature. Stockholders' equity represents amounts that have been invested in the firm and amounts that have been retained and not paid out in dividends. So again, reiterating long-term liabilities, they're notes payable due after 1 year, bonds payable due after 1 year, capital leases, and I'll explain that in a few minutes, mortgages due after 1 year. Stockholder equity represents common stock, preferred stock, retained earnings, and even though it's not listed on this slide, additional paid-in capital. Now there are two types of leases that a company may be involved with. One is called an operating lease, and one is a capital lease. And it's important that you know the difference between these two. In the case of an operating lease, the lessor owns the asset and the company is leasing it and treats the payments as an operating expense. So the person owning the operating lease receives lease payments or rents, and the company paying the rents out deduct the operating items as expenses in the year or period that they're paid out. On a capital lease, the asset is booked as an asset on the lessee's books, and the related liability is also booked on the balance sheet, and then the lessee depreciates the asset over its useful life and then makes payments on the liability, and the payments are considered to be a reduction in principal and interest. So the capital lease looks like a note rather than an operating lease. And so on a capital lease, the lessee owns the asset. In the case of the operating lease, the lessee does not own the asset. In the case of the capital lease, the lessor books the item as a receivable on their balance sheet, and the payments they receive reduce that receivable over the period of time. There is a great deal of language out there from FASB that discusses how operating leases and capital leases should be treated. Components of stockholder equity: common stock, preferred stock, additional paid-in capital, retained earnings, and treasury stock. Remember that common stock is a stock that is sold to the investors and has the lowest rank as far as liquidation is concerned. Preferred stock ranks above common stock in liquidation. Additional paid-in capital is the difference between the par value of the stock and the amount that the stock was sold to the public. Retained earnings represent profits the company has made and have been retained in the business and not paid out in dividends. Treasury stock is stock that has been purchased by the company, its own stock, and is being held in the treasury for some future use. I might also back up and talk about a contingent liability. A contingent liability is a liability that does not appear on the balance sheet, but appears in the footnotes. And if you look at the footnotes of the Amerisource Bergman Company, you'll find a discussion of contingent liabilities. For example, maybe the company has been involved in a lawsuit of some type, and the party suing them expects to receive damages. The company's attorneys believe that they will prevail in the lawsuit and win it and will not have to pay out any funds. But GAAP still requires that the company discuss this possible liability in the footnotes to put the reader aware that there is a possible liability out there that could occur even though it has not been recognized as a liability on the balance sheet. Now let's talk about types of dividends and stock splits. A dividend can be a cash dividend or a stock dividend. A cash dividend means that the company pays out a dividend in cash to the shareholders, either the preferred or the common shareholders. Some cases, the directors may decide to use and issue a stock dividend. So rather than pay out cash, they issue out new shares of stock to the shareholders as a dividend. Then the shareholder has the option of either retaining the shares, or they can turn around and sell the additional shares and get the cash that they would ordinarily receive as a cash dividend. Stock dividends normally only pertain to common stock, not preferred stock. You also sometimes will hear about a stock split. There are times when companies feel that their stock price is getting too high, and so they feel that more investors would be interested in buying their stock if it had a lower market value. And so what they do is they take and they split the stock. And so for every 1 share of stock, they issue 2 shares to the shareholder, which cuts the market value of the stock in half. Albertsons was a famous at doing stock splits back in the 1960s and 1970s. They had a policy of whenever their stock went to 50, they split it. So then they would issue 2 shares for every 1 share, and the market price would drop back to $25. And then historically, the price of those shares would in time go back up to $50, and they would split again. As I say, the main purpose is to keep the price of the stock down so it makes it more feasible or more appeasing to purchasers who might be looking to invest in the company. Okay, now let's talk about calculating the par value of a share. By definition, the par value is what each common share is worth on the company's books. It is different than the market value. The market value is what the investor can sell the shares for in the open market. So to arrive at book value for common shares, you take the common stockholders' equity, which is common stock, additional paid-in capital that relates to the common shares, not the preferred shares, the retained earnings, less the treasury stock. Then you divide that number by the shares of common stock outstanding. So what you ignore in making this calculation is the value of the preferred shares on the books in the equity section, and any additional paid-in capital that relates to the preferred shareholders. You only want to look at what relates to the common shareholders. Now we want to look at a calculation called return on equity. How much are we returning to our shareholders through earnings each year? Let's assume that the equity at the beginning of the period was $2 million. The equity at the end of the period was $3 million. So the average equity was $2,500,000, which is 2 million plus 3 million divided by 2, or 2,500,000. The net income was $200,000. So you then divide the $200,000 by the 2,500,000, so the return on equity would be 8%. This is very important to the shareholders because they want to get a reasonable return on the money they have invested with the company. And so this is a ratio that is calculated by management and compared to projections to make sure they're returning to their shareholders an amount equal to what they had promised them at some point in time.